chapter 4, we talked about how do you account for companies that sell merchandise, and we did speak about inventories, because if they're selling merchandise, that's probably one of the biggest accounts on their balance sheet is their inventory, because they have to keep enough in stock to be able to have enough to sell to their customers. But it also creates a pretty significant accounting problem for us, because the question becomes, how do you actually account for the inventory? Because often, let's say you're selling pencils. Well, you are purchasing those pencils from somebody to resell them. And what you pay for those pencils may change with each order that you place, depending on what you can get those pencils for. So maybe one time you only spend 2 cents per pencil, and the next time it might cost you 4 cents, and the next time it might be 3.5 cents. So when you sell the pencils, you have to determine which pencils are you selling. Are you selling the ones that only cost you 2 cents, or the ones that cost you 3 cents, or the ones that cost you 4 cents? And that particular issue makes accounting for inventories a bit challenging. And there are different methods to use when you're accounting for inventory. The main thing that you have to do is be consistent. You can't flip-flop on inventory methods just from one month to the next. You have to pick one and stay with it, and if you do choose to make a change in your method, it has to be disclosed in your accounting statements and explained as to exactly when you made the change and how it affected your inventory amounts, which also then ends up affecting your gross profit and your net income amounts. So accounting for inventories is a bit complicated, but it's extremely important to do correctly so that you arrive at the correct amount of net income at the end of each period. All right, in this first section in Chapter 5, there's some definitions that you should look at and read for yourself. Another thing that you have to keep in mind is what we said in the last chapter, is that merchandise inventory includes cost of anything that you have to spend that brings an item to a saleable condition and location. So you have to take into account discounts that you receive and other expenses that you might incur to be able to sell that, such as tariffs, freight, storage, insurance. All of those things become part of the cost of the inventory. So even if you only paid 10 cents for a particular item, if you had to pay freight to get it to you, if you're having to keep it in storage, if you're having to pay insurance on it, all of those become part of that cost. So your inventory cost has to take all of that into account. And that's what it says here. Accounting principles prescribe that incidental costs be added to inventory. The matching principle states that inventory costs should be recorded against the revenue in the period when the inventory is sold. So you may buy something this period but not sell it until next period, and so you have to try to match it, the cost of that inventory, with when you actually receive the revenue from it. Those are some basic principles. The next section here talks about the kinds of controls that you have to take to try to keep a handle on your inventory. As you all know, inventory can disappear, people steal things, people make mistakes and miscount. So there's certain auditing type things that we try to do to keep our inventory safe and to have the account be accurate. In the next section, we're going to talk about how do we arrive at the dollar amount that we attach to the inventory that we have. The first thing to talk about in reference to that is these are the things that are going to affect that particular figure that you're looking at. What are the items that are included in their inventory and obviously their cost? What is the costing method that your company has chosen to use? And we're going to talk about 4 different methods. They're listed here. We're going to get into more detail in a second. And what is the inventory system that you're using? Is it perpetual or periodic? We're going to explain that in a minute as well. And then there's another thing called the use of market values. We'll talk about that too. That gets even more complicated, and we won't get into it too much in this particular class. All right. So one of the most important issues in accounting for inventory is determining the per unit cost assigned to those inventory items. So obviously if they were all purchased at the same cost, it's a very simple process. If every pencil you only paid 2 cents, then it's 2 cents per pencil. However, as we've already talked about, there can be other costs involved in your inventory, like freight and storage and insurance. Also, you may have paid different prices for the things that you received. So because of that, you have to decide how you're going to assign cost to that inventory into your cost of goods sold. So these are the different options: specific identification, first in, first out, last in, first out, and weighted average. And this chart here shows you that the first in, first out is used the most, and then another 27% of the companies use last in, first out, 20% use weighted average, and then only 3% use something different than that, such as specific identification. So the most common is first in, first out, but last in, first out is also quite common. Each method assumes a particular pattern for how costs flow through inventory. Each of these is acceptable according to United States accounting principles, and what you use does not have to actually follow the physical flow of your goods through your system. We'll talk more about that too. So just keep that in mind. Physical flow and cost flow do not have to be the same. All right, so let's discuss these different cost flow assumptions. Okay, let's take this example. Assume that 3 identical units are purchased separately at the following 3 dates and cost. So it's the same item, but on May 1st you paid $45 for that item. On May 3rd you bought another one just like it, but this time it cost you $65. And on May 6th you bought another one, and this time it cost you even more. It was $70. Now, you sell a unit on May 7th for $100. The question could be, which one did you sell? Did you sell the one that you bought on May 1st, the one on May 3rd, or the one on May 6th? Does it matter? Because all 3 of them are the exact same item. So the question is, we have to determine how much did this particular unit cost us, and therefore how much profit did we make on it. In order to determine what that is, it's based on which of these cost flow assumptions that your company is using. If your company has adopted FIFO, meaning first in, first out, then that means the one you sold is the first one you purchased, which would be the one that you paid $45 for. So if you sold that one for $100, you just made $55 on that particular item. So if you're using first in, first out, you take the first one you received, and whatever you paid for it is going to be your cost of goods sold in that particular case. Okay, if you're using LIFO, last in, first out, again going back to this example, then based on the fact that your company has adopted LIFO, then the one that you sold is the one that costs $70. So you sold it for $100, it cost you $70, so in this case your gross profit on it would be $30. Now, weighted average assumes that the costs flow at the average of the cost that you paid for it. So in this case you bought these 3 items, 45, 65, and 70. To get the average of that, you would add those 3 numbers together and then divide by 3. So that makes each unit $60. So if your company has adopted this way of dealing with cost flow, then your cost for that item that you sold on May 7th would be $60, You sold it for 100, so your gross profit on it would be $40. So you can see here that your cost flow assumptions are going to have a major impact on your gross profit and on your inventory cost. So you have to know which of these your company is using, and you have to apply it consistently. So here they're showing you the examples of FIFO, LIFO, and weighted average. Now, once you've determined the cost of what you sold, you also have to then determine the cost of what you have left in inventory. So in this case, we bought 3 items, and because we're using FIFO, then what the one we sold on May 7th cost us is $45. So we have net sales 100, cost of goods sold 45, our gross profit is 55. We have 2 items left in inventory. These 2 items, because this is the one we're going to say we sold, and so those 2 items means that our inventory value right now is $135, 70 plus 65. So what we still have in inventory has a cost of $135. But when you use last in, first out, you can see that net sales remains the same. We got $100 for the item, but in this case, the last one we purchased was $70. So you take $70 away from that, that's your cost of goods sold. Your gross profit is only $30 as compared to $55 over here. And then your inventory is now worth $110 because it's only the last 2 items. These are the first 2 items that you purchased. These are the 2 left in inventory, and if you add that together, you get 110. Now, weighted average, net sales are the same, but in this case, your cost of goods sold is only $60, the average of these 3. Your gross profit is $40, and what you have left in inventory is 2 items at an average cost of $60 a piece. 2 times 60 is $120. So this is extremely important because these numbers are very different. And it's all based on the cost flow assumption that your company has adopted. And it's going to change your balance sheet accounts and your income statement accounts, which is definitely going to change your net income at the end of the period. Okay, this next section provides a comprehensive illustration of inventory costing methods. They're talking about a specific company in this case, a company called Trekking. They carry one type of mountain bike whose sales are directed at resorts that provide inexpensive mountain bikes for complimentary guest use. Its customers usually purchase in amounts of 10 or more bikes. Now, the information we have here is shown from the month of August, and it shows their purchases and sales during August. And at the end of August, they had 12 bikes left in inventory. So you can see here what they purchased and at what cost they paid for it. And as you can see, they have 4 different cost amounts that they paid. But what they sold doesn't change. They sold 20 units at $130, and then they sold another 23 units at $150 a piece. Now, in terms of the type of inventory system, Trekking uses the perpetual inventory system, which is the most dominant one that's used in the United States. What that means is that you are continually updating the inventory account every time you make a purchase or a sale, and we'll talk more about that later. But every time you do a purchase or a sale, you're updating your inventory account. You're not waiting until the end of the period to update the inventory. Now, there's another way of doing this that we didn't talk about up above called specific identification. And this is where each item in the inventory can actually be specifically identified. So you may buy 5 items and sell 1. And this would be where you could identify that the one that you have sold is exactly number 3 that you purchased or number 2 that you purchased. And this is most often used in a situation where you have very unique, expensive items, such as luxury cars, where you don't only have one or two of a particular type of car, and you know very clearly which car it was you sold. So with specific identification, it's used when you can easily identify which of the items that you sold. Alright, so if we applied this specific identification to the example that we're given here, I think you can follow this by looking at it in terms of exactly which of the bikes were sold, and therefore being able to price out exactly what they were sold for. In this case, they were able to determine, using specific identification, that the cost of the bikes, the 43 bikes that they sold, were $2,000 from this group and $2,582 from this group. And therefore, the cost of goods sold is $4,582. And then the bikes that they have left, remember they have 12 bikes left in inventory, and they can also identify exactly which bikes those are. 5 of them that cost them $115, and 7 of them that had cost them $119. So the value of the bikes left in inventory at the end of the month is $1,408. That's based on specific identification, because they can identify that they actually sold 20 bikes up here, 8 at the 91 and 12 at 106. And then they sold 23 bikes down here, 2 that had originally cost them 91, 3 that had cost them 106, 15 that cost them 115, and 3 that cost them 119. So their cost of goods sold is $4,582. The amount left in inventory is $1,408. Again, this probably wouldn't be the way you would do it with mountain bikes like this, but it's more practical for companies with expensive or custom-made inventory, such as car dealerships, jewelers, fashion designers, things like that. It would probably be more common for a company selling bicycles to use one of the other 3 methods that we've already discussed. Again, the next example that they're going to give you is they're going to take the same information that we've already talked about up here with trekking and apply it using the first in, first out method. And I'm going to let you look that over since I've already explained that. But this is what you would come up with using first in, first out. This is what you would come up with using last in, first out, shown here. And then they do it again with weighted average. And I think they summarized that down here, which is what I'd like you to look at. So, depending on which method you use, your cost of goods sold number is going to differ. So under specific identification, the sales are the same under all 4 of these because you sold 23 bikes for a certain amount of money, so the sales amount is the same. The question is, how much did those bikes cost you based on the method that you have chosen? Under specific identification, it's $45.82. Under FIFO, $45.70. LIFO, $47.30, the highest figure, and weighted average is usually somewhere between these two, $46.22, which gives you a different gross profit in each of these cases. Generally speaking, under LIFO, you're going to have a lower gross profit than you do under FIFO. So that gives you your income, and this is income before taxes. And because you have a higher cost of goods sold under LIFO, you're going to have less income before taxes than you do under FIFO. And remember, these are the 2 most common methods. That's why I'm pointing them out. If you're in a 30% tax bracket, you're going to pay more tax under FIFO because your income is higher. You're going to pay less tax here because your income is lower. But that also means your net income is lower overall. And as a company, even though you want to pay less money in tax, you also want to look very profitable for your stockholders. So sometimes companies would rather see a higher net income even if it cost them more money in tax. Now, the other side of this is, what do you have left in your inventory? And that goes on the balance sheet. And under specific identification, the 12 bikes that you have left are worth $1,408 or cost you $1,408. FIFO $1,420. LIFO is going to be less because it's recorded at the earlier cost, because remember, it's last in, first out. And then weighted average again is going to be somewhere in between. Read this information here because this is important in terms of understanding how it's going to affect net income and how it's going to affect your inventory figure going into the next period. Because remember, this is on your balance sheet. This goes into the next period as the starting inventory for the following period. So read through this and try to get a grasp to understand how these different cost assumptions affect your bottom line in terms of your net income and your tax ramifications. Again, as we talked before about consistency, the consistency concept in accounting prescribes that a company uses the same accounting methods period after period so that the financial statements can be comparable across periods. If you do make a change, you have to do full disclosure, describing exactly its change, why you did it, and its effect on your income. Okay, we'll pick this up in the next section.